Good morning, afternoon, or evening, ladies and gentlemen, all in crypto here, and welcome back, guys, for another daily cryptocurrency market update. A new week has commenced, and a happy Monday to each and every one of you. Today, we are going to be covering a number of things. We're going to be looking at the stock market in relation to Bitcoin and how actually we could see some of your stocks, such as Apple, Microsoft, perhaps Meta, really potentially leading the way for the cryptocurrency market, Bitcoin, and be perhaps a glimpse into the future. We will be diving into that. We will be doing some technicals. We're going to be looking at, of course, rates, the probability for rates, some of the comments that were made from the IMF chief in regards to the Fed having to do more rates. OPEC and the Saudi Arabia essentially came out and have said that they're going to actually continue to cut oil production. Again, we've stated that they're not doing this because there's a massive demand. They're doing this ultimately because they see a drop in demand and want to keep the price where it is. We do think oil and a basket of commodities are still a short. I think inflation's coming down significantly. It's a lot lower than the 4.9% where the Fed have it in regards to a basket of consumer goods. And ultimately, we don't think the Fed has any reason to hike at this point. Of course, we've got CPI and a PI the day of the actual rate decision, which is about 9 days away. I want to start things off really with the markets are marginally down. We've got the futures market down, we've got the dollar up, we've got gold down. And I think the main narrative at the moment for the markets, of course, you've got the Fed and their decision, but there's another narrative that's really taking the forefront. And that narrative is, of course, the Treasury. We had the debt ceiling that was raised. And one of the sort of things that the Treasury did in order to get this debt ceiling raised was they dumped a lot of their general account. And I want to show you a chart on TradingView of their general account, maybe a little bit of a correlation with what happens with the markets, and actually how this is going to be liquidity restrictive because they're going to be issuing and dumping a load of bonds onto the market. T-bills typically is how they prefer to do it, short durations. And actually this is going to theoretically take money from the equity space and potentially the crypto space, which there's a correlation with. You know, when you're looking at Bitcoin, it's against the dollar. When you're looking at the S&P, it's typically against the dollar, depending on what currency you're trading in. But there's going to be a flow of liquidity into the Treasury account. And actually, the Treasury have been dumping liquidity, which has offset quite a bit of QT, and that's now going to reverse. There's a number of other things going on. You've got the June equinox. You've got a variety of things taking place, but this is a real narrative that's worrying the markets. You've got to remember as well, we do have CPI next week. We've also got the rates decision. There may be a bit of de-risking as the stock market and everything has gone on a pretty nice run. So let's jump straight into that, guys. Let's take a look at the Treasury's general account. So one of the pretexts of the Treasury asking for the debt ceiling to be raised is the fact that they couldn't have had nearly $1 trillion on their general account and have got the ceiling passed. And you can see they've been dumping a lot of their account into the markets. Now, they are set to and have already started auctioning off bonds that they're going to issue and put into the market that they expect to get bought up in order to raise their cash reserves. This is the S&P overlaid. So the correlation perhaps isn't that stark, but you can see actually as they dumped, this has probably had a supporting factor in regards to liquidity for the S&P and other markets. But this is about to turn its head. And you can see they were dumping here. You had this really great rally. And then they sort of turned and looked for the upside. And as they were taking liquidity from the market along with the Fed, this is why you had this. And then there's been a sort of turn. So they are going to look to, I think, take it back to around about $500 billion. This probably not best to draw that. It's too early in the morning for drawing straight lines, guys. Maybe $500 billion all the way up to 600 billion. So that's going to be a lot of liquidity that they're going to put onto the markets. This is dangerous, not just because they're going to look to get liquidity out of other markets into these T-bills, but also because we know we've had a lot of banking issues, whether it be in the UK with the gilts market or whether it be SVB or whoever it may be, with the bond market. All banks, pensions, everything is stuffed with bonds. A lot of the times because they're mandated to do so, and of course it's a government-backed instrument that they think has a degree of more safety, and historically that's been the case. However, one day we may find that it isn't, but I still think we're a while away from that. So with them dumping more bonds onto the market, that's more sell pressure in the bond market. That means the yield market, which has already done quite well on the understanding that this is going to happen, we have seen climb. So remember, one of the reasons we think the Fed's done is because we think the 2-year yield has potentially topped out at 5%. We'll see. Where are we wrong? Well, if this goes on and putting a new all-time high, then we not new all-time high, new high, then we know that potentially there's more rate hikes in store. Right now, we don't think that there's going to be another rate hike. However, this could change. We got CPI the day before the actual FOMC meeting and rate decision. And of course, we've got PPI on the day of. We do think inflation's come down significantly. But this is something to watch in regards to the balance sheet, because it is going to be taking liquidity from the markets. I think the markets are marginally down today. Probably a little bit of this news is baked into that. But also, you do have a major week, not this week necessarily, but a week ahead. We've got two central banks. If I'm correct, it's the Bank of Australia and the Bank of Canada upping rates, they have rate decisions this week. Both of them are choosing to hold rates where they are. So that could be foretelling in regards to what the Fed might be doing. You can kind of see why the dollar perhaps is gaining a little bit of strength on the back end of all that, because if other, the Dixie is comprised of multiple, it's against a basket of other currencies, the euro being one of the predominant ones. And ultimately, if other countries are holding their rates and the dollar's still at this point where potentially we don't know if it's going to or it's not going to, then this is probably why we're having quite a bit of this. And we'll see what this brings. In 9 days, this is so key for markets because this is really going to set the direction of them. We do believe that CPI is a lot lower using true inflationary stats, which seem to be getting a lot of coverage at the moment, than where the Fed have it. But it's the Fed data that they go on, not true inflation. This was a really interesting tweet talking about conflicting policies. The government is practically undoing the Fed's attempts to curb inflation. Throughout history, today, we are experiencing the most aggressive fiscal policy given how low the unemployment rate is. Keep in mind that military spending has not even reached elevated levels yet. In fact, the current defense budget is one of the lowest in 60 years. With a 7.3% government deficit, the national debt problem is compounding at an alarming pace, even before the possibility of a recession. So it's interesting because they're doing very tight monetary policy, but even interest rates, in a sense, could be seen as stimulatory. Now, that doesn't make any sense on the face of it, but if you think about the spending that the government has to do to honour those bills, at 5.25%, we looked at government spending and it was, interest rate payments that the Fed and the government have got to fork out. And that's nearly $1 trillion. That money does flow into markets, but the problem is it comes from, it has to come from somewhere, right? And this is why we've had the dollar bill. The dollar bid has just basically been led, and the dollar rally all the way to, what was it? 114 was really led via interest rates. And this is why interest rates are such an important problem. If you get the dollar right, you're usually going to get the other side of the trade right. But there's a lot of conflicting policies. And I actually I always look for Lynn Alden's comments. She essentially put down here, where it all gets really awkward is when the Fed loses control of its balance sheet due to a massive and sustained Treasury issuance. So again, this is an individual showing a chart. This wasn't planned, me pulling this up. The thing is as well, who's going to buy all these bills? And if there aren't buyers for them and there's the sell pressure, there's no buyers, you're going to get a spill and potentially a gilt what we saw happen in the UK with the gilt market sort of situation, where the Fed then has to become the last buyer. We've looked at the balance sheet and markets. So this is the Federal Reserve's balance sheet. Again, with SVB, they had to issue for the first time. They've continued to do quantitative tightening, which is dumping the bond market. Again, we've got Yellen, who's going to be issuing bonds to raise their reserves, but that's essentially by them. It's almost exacerbating this. Question is, what happens as a result of it? And do they have to start? Markets loved this. Again, markets also loved going from 75 basis points down to 25. We think they're going to love them going and not doing it and pausing. But when we see this uptick, and this could be the catalyst, there's more than one way that this can play out, right? And the markets are going to give you kind of clues in regards to how they're acting. But it's something massive to watch. It's why I think the markets are marginally down today. You've got gold down, you've got the dollar seeing a bit of strength, you've got the futures market marginally down, but I think that will be likely due to people having looked at last week and going, okay, you've got the NASDAQ potentially at a double top here, or a short-term double top, I must say. Remember, we told people don't short here. And actually, where we think that the NASDAQ is potentially leading the way, and some of your stocks like Apple, Microsoft particularly, is kind of leading the way for the indexes, but actually potentially for Bitcoin and certain cryptos that have very similar DNA. Most cryptos are at a level here in regards to altcoins. They're lagging Bitcoin, as typically is the case as we bridge from one trend to another. You do have, I think, the equity market leading things. But so this is a situation we need to absolutely watch. She then goes on to comment, the hard part is working through this combo, ongoing large fiscal deficits of side. Let's check out this tweet, actually. Lynn's great. So the hard part is working through the combo, ongoing large fiscal deficits of size, and ironically, higher rates increased the deficit, and inflationary and stimulatory over the long run. They're locked in the demographics and political polarization. At the speed of magnitude of higher rates over the past 16 months squeezes banks, the Fed's QT. This is the thing. There's more than one thing going on here. I don't know why Raul's being being tagged here. And it's going to be interesting to see how it plays out. The markets are really what we're going to watch, particularly the yield markets, because the 10-year yield's typically going to lead the dollar, and the 2 years going to lead the Fed's rate decision. So it's going to be very, very interesting. Moving on, the IMF chief today came out. So yesterday, the IMF chief came out and says no significant slowdown in lending, and the Fed may need to do more. So they have to talk tough. Again, the Fed is like that parent that's trying to get the child to do something, and he's doing it by over-exaggerating the consequences of them not doing it. That's kind of that's the best analogy I've heard for the Fed in regards to what they're doing to the markets. They're talking them down. Okay, I've heard lots of people say, okay, well, the Fed want to smash the S&P. Why? The Fed want to take inflation out. I think there's been 14 hiking cycles. 11 of them have led to a recession. So it's quite a high probability that takes place. We just don't think it takes place for a while. We look at the yield curve and everything else. But talking about the IMF, talking about more rates, we've still got 78%, according to the CME group, that they don't do another hike, and 21% that they do. Remember CPI, we've got a number of other data that's going to come in beforehand that we need to watch because this may change it. You also had OPEC yesterday. OPEC, or oil prices pop after Saudi Arabia pledged more voluntary production cuts. They're doing this, so you'd think this would be bullish for the price of oil, but they're not doing this, just like we said with OPEC when they originally came out, because they think that oil is strong. If they're selling a massive amount of oil and the demand is there and it's really high and strong and the market is good, they wouldn't do cuts. They're doing cuts because they foresee potentially further issues. And actually, you can kind of see that with oil. Maybe you do have some sort of a head and shoulders here. If you look at a basket of commodities like the spider, it doesn't look great. It looks bearish. And actually, you've got the S&P that looks bullish. So, very interesting news. To finish things off, we spoke about where we are sort of daily. if you look at Bitcoin, right, you've got this inverse head and shoulders, 35k or 40 plus target. We do think you're going to get there, guys. You know, we're long in position for it. We think altcoins will come to their own, come into their own, likely when this next move and confirmation of lots of these levels start. But you can see you've got this going on, and you've ran into this point here. We ultimately think it's going to do this. To be very, you know, we looked at your EMA traders and how you might get an influx of them coming in, certainly as you're coiling up around this EMA. We do expect this to hold, by the way, guys. And historically, actually, the 200 MA, sorry, has done quite well. We're not moving average traders. We just do pay attention to all sides of the market. But you can see, actually, if you look at the stock market, which has led the sort of general rally, you know, it started in November. Bitcoin and crypto didn't appreciate that because of FTX. You know, if you look at the NASDAQ, for example, it was at its kind of key resistance, you know, that it's now gone through sort of further down here. You know, and it kind of winded up, potentially inverse head and shoulders, looking for upside. The S&P as well, it seems to be, you know, Bitcoin's here, moving forwards up. Apple, for example, is actually up today. You know, and this is the interesting thing. If we look at a number of stocks, quite a few of them are marginally down pre-open. Microsoft, for example, again, Bitcoin's here. And we think ultimately, you know, this is what the future looks like for Bitcoin. I think the stock market is very much leading and showing us the way there. Coinbase, I like Coinbase stock. I'll be buying some more Coinbase stock at some point. Meta, I mean, just interesting, isn't it? You know, and people have been bearish for 6 months, and this has been what the market's been doing. You know, I understand that if you're bearish, and we agree with the bears on many things, just timing we think is different, and we'll try and catch the short-term trends. We think this is an uptrend that you're now in, and we'll you know, hopefully catch it when as it merges into a downtrend potentially. But being bearish really hasn't paid you at all. And I think, you know, if you look at altcoins, you know, again, they're kind of like, you know, same place. You've got this going on. They bumped into resistance. We do think this just goes like, you know, you see some sort of upside. I can actually see new all-time highs for many altcoins. Certainly if the S&P goes on and does that, and there's an interesting sort of set of circumstances that might bring that in the macro markets. Yeah, I think this could be explosive, guys. Certainly as they're looking to sort of bring rates to an end. You know, but let's deal with the short term. You know, more upside today is going to be interesting. I think you're generally going to have quite a lot of people de-hedging or hedging and de-risking going into CPI and a big next week, and lots of taking place. But we'll keep you up to date on a daily basis, guys, and everything going on. I think there's a big narrative in regards to the debt ceiling and the Treasury, and that being a liquidity draining event. But there's lots of buybacks and things with stocks on a kind of stock level. On that note, as this has gone on for nearly 20 minutes, I'm going to love and leave you. If you've enjoyed this content, as always, a like is appreciated. So is a comment. We'll catch you all in the next one. Thanks a lot for watching, guys. See you in the next.